Stop right there. If you're working from home and dreaming about all those sweet tax write-offs, I need you to pause. Seriously, hit the brakes on that thought right now, because what you think you know about work-from-home tax deductions could be a dangerous, expensive misconception. I'm here to give you the unvarnished truth, the deep dive into who actually qualifies for work-from-home tax write-offs, and more importantly, who absolutely, positively does not. Trust me, this isn't just about saving a few bucks. This is about saving you from an audit nightmare, from penalties, and from the crushing stress of getting it wrong. I want to save you from this nightmare. So listen closely because this is urgent and it directly impacts your financial future. Here is the reality, and it's a tough pill for many to swallow. The vast majority of people who started working from home during the pandemic, or even before, do not qualify for the federal home office deduction or other unreimbursed employee business expenses. Let me explain why this matters so profoundly. Before the Tax Cuts and Jobs Act of 2017, which took effect in 2018, employees could deduct unreimbursed employee business expenses on their federal income tax return, itemizing them on Schedule A. This included things like home office expenses, professional development, and even uniforms. It was a lifeline for many salaried employees whose employers didn't cover these costs. But that all changed. The TCJA eliminated these deductions for employees at the federal level, and this change is set to last until at least 2025. This is not a temporary hiccup. This is a fundamental shift that many people are still completely unaware of, and it's leading to massive mistakes come tax season. Imagine you are Sarah, a dedicated marketing manager. When the world shifted, your company sent everyone home. You didn't have a suitable workspace, so you invested in a new desk, a comfortable ergonomic chair, a high-speed internet plan upgrade, and even some fancy office supplies to make your new home office functional. You spent hundreds, maybe even thousands out of your own pocket because you wanted to do your best work, and your company didn't offer reimbursement for these items. Now, tax season rolls around, and you remember hearing about work-from-home write-offs. You think, great, I'll deduct all these expenses. Stop right there, Sarah. Under current federal tax law, because you are an employee receiving a W-2, those expenses, no matter how legitimate or how necessary for your job, are not federally deductible. The consequence of getting this wrong? You claim those deductions, the IRS flags it, and suddenly you're facing an audit. An audit is not a friendly chat. It's a rigorous examination of your financial records, and if those deductions are disallowed, you'll owe back taxes, interest, and potentially hefty penalties. This is why understanding this distinction is so critically important. It's not about being clever. It's about following the rules to avoid catastrophic financial setbacks. Now, before you lose all hope, there's a crucial caveat. While federal law has changed, some states do still allow deductions for unreimbursed employee business expenses. So if you're in a state like California, New York, or Pennsylvania, for example, you might have some state-level deductions available. But this is not a blanket rule, and you absolutely must check your specific state's tax laws or consult a local tax professional. Do not assume, do not guess. The solution for employees is clear. Unless your employer reimburses you for these expenses, or you live in one of the few states with specific exceptions for unreimbursed employee expenses, you generally cannot deduct your work-from-home costs on your federal return. It's a harsh truth, but it's the truth. All right, so who does qualify? This is where the narrative shifts dramatically. If you are self-employed, and this is a broad category that includes freelancers, independent contractors, gig workers, small business owners, sole proprietors, or anyone who receives a 1099 NECI or files a Schedule C, then congratulations, you are generally in a different ballgame. For you, the home office deduction and other legitimate business expenses are very much on the table. But even here, there are strict rules, and you need to understand them inside and out to avoid trouble. This isn't a free-for-all. It's a targeted deduction with specific criteria. Let's talk about the infamous home office deduction for the self-employed. The IRS has two stringent requirements that must be met: exclusive and regular use, and principal place of business. Let's break down exclusive and regular use first, because this is where many people trip up. Exclusive use means that a specific area of your home must be used only for your trade or business. Not sometimes, not mostly, but only. This means if you're working from your kitchen table during the day and then your family eats dinner there at night, that kitchen table area does not qualify for the home office deduction. If you have a spare bedroom that you sometimes use for guests, but primarily as your office, it still doesn't qualify if guests are using it, even occasionally. The IRS is looking for a dedicated space. Regular use means you use that space on an ongoing basis, not just once in a while. Let me give you a specific scenario. Imagine you are Marco, a freelance web developer. You've converted your spare bedroom into a dedicated office. It has your desk, your computer, your development books, and nothing else. No guest bed, no personal belongings, no family storage. You work from there 5 days a week, sometimes more. This space likely meets the exclusive and regular use tests. Now, consider Laura, a new consultant who primarily works from clients' offices but occasionally checks emails and prepares reports from her living room couch or a corner of her bedroom. Laura's situation, while she is self-employed, would not qualify for the home office deduction because there's no exclusive space, and the regular use might be debatable, but the exclusive part is a clear fail. The consequence of Laura claiming this deduction? Disallowance, and potentially an audit if it's egregious. The solution for Marco is to maintain that dedicated space and document its exclusive use. For Laura, it's to understand that while she's self-employed, her working arrangement doesn't fit the home office criteria, and she should look for other legitimate business deductions instead. Then there's the principal place of business rule. This means your home office must be the main place where you conduct your business. Even if you have other locations where you conduct business, your home office must be where you perform your administrative or management activities for that business. For many remote freelancers and small business owners, this is straightforward. If you're a graphic designer working solely from your home is your principal place of business. If you're a plumber who travels to clients' homes but does all your scheduling, billing, and administrative work from your dedicated home office, that also qualifies. This rule prevents someone who primarily works out of a rented office space from also claiming a home office deduction for minor administrative tasks done at home. It's about ensuring the deduction is for a truly central part of your business operations. Once you meet these stringent criteria for the home office, you have two methods to calculate your deduction. The first is the simplified option. This method allows you to deduct $5 per square foot of your home used for business, up to a maximum of 300 square feet. So if your exclusive home office is 150 square feet, you can deduct $750 of $5 costs $150. It's simple, it's easy, and it requires less record keeping. The common misconception here is thinking it's always the best option. It's not. It's often less than what you could claim with actual expenses. The second method, the actual expenses method, is where you can potentially unlock greater savings, but it demands meticulous record keeping. With this method, you calculate the actual expenses of your home office. This includes a portion of your rent or mortgage interest, property taxes, utilities, electricity, gas, water, homeowners insurance, repairs and maintenance specific to the office space, and even depreciation of your home if you own it. You determine the business use percentage of your home, usually by dividing the square footage of your office by the total square footage of your home. So if your 200 square foot office is in a 2,000 square foot home, your business use percentage is 10%. You then apply that percentage to your allocable home expenses. For instance, if your annual rent is $24,000 and your business use percentage is 10%, you can deduct $2,400 for rent. Add to that 10% of your utility bills, 10% of your insurance, and so on. Let's compare. If Marco, our web developer, has a 200 square foot office, the simplified option gives him a $1,000 deduction, $5 to $10, $300. But if his total home expenses, rent, utilities, insurance, etc., are $30,000 a year, and his business use percentage is 10%, his actual expenses deduction would be $3,000. That's a huge difference. The common mistake here is rushing to use the simplified method without even calculating the actual expenses. The solution is to do the math for both methods and choose the one that gives you the larger, legitimate deduction. But remember, with actual expenses, every single expense claimed must be documented with receipts, invoices, and clear records. If you can't prove it, the IRS will deny it. Beyond the home office itself, self-employed individuals can deduct other ordinary and necessary business expenses incurred while working from home. What does ordinary and necessary mean? Ordinary means it's common and accepted in your industry. Necessary means it's helpful and appropriate for your business. It doesn't have to be indispensable to be considered necessary. This is where you can deduct things like your business portion of internet service, your business phone line, or the business percentage of your personal phone bill, business software subscriptions, Adobe Creative Suite, project management tools, office supplies, pens, paper, printer ink, business equipment, laptops, cameras, specialized tools, professional development courses or certifications relevant to your business, and even business-related publications. The common misconception here is trying to sneak in personal expenses. Imagine David, a freelance writer, buys a new 70-inch television for his living room and then tries to claim it as an office expense because he sometimes watches industry news on it. That's a red flag. Or he claims his entire personal cell phone bill even though he uses it 80% for personal calls and 20% for business. The consequence? Disallowance, and if it's a pattern, it signals an intent to defraud, which can lead to severe penalties. The solution is rigorous separation. If you can, have a dedicated business internet line, a separate business phone, and definitely a separate bank account and credit card for all business expenses. If you're using a personal item for business, you must accurately track the business use percentage. Keep detailed logs for phone calls or internet usage if you're splitting the cost. This is your shield against IRS scrutiny. Let's quickly address different demographics, because the rules apply universally to the self-employed, but the context changes. For the new freelancer or gig worker, you might be just starting out, picking up side jobs on platforms like Upwork or Fiverr. Even if this isn't your full-time income, if you're operating as a business, you qualify for these deductions. Don't leave money on the table. Track every single penny you spend that's ordinary and necessary for your gig. Your home office, your internet, your specific software licenses, these are all legitimate if you meet the criteria. Don't think because it's a side hustle, it's not a real business in the eyes of the IRS. If you're making money and you're not an employee, you're a business. For the established small business owner, you likely already understand many of these principles, but perhaps you've been hesitant about the home office deduction. Revisit your setup. Are you truly meeting the exclusive and regular use criteria? If so, ensure you're maximizing that deduction, whether through the simplified or actual expense method. And are you meticulously tracking all your other WFH expenses? Often, established businesses get complacent. For the retiree starting a consulting business, you've entered a new phase, perhaps offering your expertise. Treat this new venture like a serious business from day one. Set up your dedicated home office, track all your expenses, and understand your tax obligations. Don't assume because you're retired the rules are different. If you're earning income from a business, you're self-employed. For the student with an entrepreneurial spirit, maybe you're running an e-commerce store from your dorm room or offering web design services. While a dorm room might not be suitable for a traditional home office deduction due to the lack of exclusive use or ownership, other business expenses like software, equipment, and marketing costs are absolutely deductible if they are ordinary and necessary for your business. The principle remains: if you're self-employed, these deductions are relevant. Now for the absolute critical warnings and advice. Record keeping is paramount. I cannot stress this enough. If you claim a deduction, the IRS expects you to be able to prove it. This means keeping receipts, invoices, bank statements, credit card statements, mileage logs, and even photographs of your dedicated home office space. If you're claiming a percentage of your internet bill for business, have a log or a reasonable methodology to justify that percentage. My friends, if it's not documented, it didn't happen in the eyes of the IRS. This isn't just about saving money, it's about protecting yourself. Furthermore, consider separating your business and personal finances. Open a separate business bank account and use a dedicated business credit card. This makes tracking expenses infinitely easier and provides a clear audit trail. Commingling funds is a common mistake that complicates everything and makes it harder to prove legitimate business expenses. Finally, and this is perhaps the most important piece of advice I can give you, this video is for informational purposes only and is not tax advice. The tax code is complex, constantly evolving, and highly individual. Your specific situation, your state, and the nuances of your business can all impact what you can and cannot deduct. Do not guess. Do not rely solely on internet forums or anecdotal evidence. Invest in your financial peace of mind by consulting with a qualified tax professional or a certified public accountant, CPA. They can review your specific circumstances, ensure you're taking all legitimate deductions, and, crucially, help you avoid costly mistakes that could lead to an audit, penalties, and immense stress. The bottom line is this: work-from-home tax write-offs are real, but they are not for everyone, and they come with strict rules. Employees, for the most part, are out of luck federally. Self-employed individuals have significant opportunities, but only if they meet the IRS criteria for exclusive and regular use of a home office and meticulously track all ordinary and necessary business expenses. Equip yourself with knowledge, keep impeccable records, and when in doubt, consult an expert. Your financial health depends on it. Don't let a misunderstanding turn into a financial headache. Take control, understand the rules, and protect your hard-earned money.